welcome once again to the Smart Money, Dumb Money show, and I'm your host as usual, Keith Richards. I'm Chief Portfolio Manager and President of ValueTrend Wealth Management. And today we have another guest interview, and this guest is a name that you might be familiar with if you read the blogs regularly. It's Craig Aucoin, and Craig has been the CFA, Chartered Financial Analyst, and he's Vice President and a portfolio manager at ValueTrend. And you might be familiar with him because he's done a few videos with me, and of course he's answered many of the questions on the Ask Us Anything blog. So it's really great to have Craig on today because he's going to be covering that side of the world that I don't cover through my blogs and through these videos. And I'm always trying to give you guys a new perspective on stuff. So this should be a really, really fun interview, and you get to hear mainly from the Craig side of the equation today, rather than having to listen to boring old me. So Craig, welcome to the show.
Thanks, Keith. Hi, everybody. And yes.
So we're going to start off because Craig and I, just like I do with all my guests, I always ask for some input on what they think they should be talking about. And Craig wanted to spend a bit of time talking about global indices and global markets and global stocks, because this is an area that people don't often look at. So Craig, why don't you highlight some of the stuff that we were discussing and give, start this off with the global look.
Right. People often wonder how we position our portfolios, and when we're looking for international exposure, it's not that we decide or we set up our portfolios in a way that, we need to have 10% weighting in Japan, and then 5% weighting in Australia, and 30% in China, etc. We don't have an international exposure parameter that are specifically in set. We are driven by the technicals, largely for when we look for country exposure. But the fundamental side, or the makeup of the country and the indices themselves, is what I wanted to talk about today. What you're getting when you invest in a particular indice that you expect to be of a country. We want to look at what the makeup is, and is it really what you might think you're getting. So that's where I wanted to start, and kind of open the door, or open the hood, and take a look at the composition there. So to start, maybe we could look at what I'm speaking of. When we're looking technically at a chart, for instance, if you're looking at a chart of France, and you're expecting that, okay, this ETF will use the iShares MSCI as an example. That indice is it is made up of, as you would expect, some French exposure. Well, that exposure is a number of companies, and those companies do business all over the world. And so, but when you think you're getting country exposure, you would think you're getting the exposure to the economic reality of that country. Well, when you get exposure to the French ETF, you're actually not getting only exposure to France. You're getting exposure to other places where these French companies do business. So the indices themselves, as the iShares, is made up of French companies that are registered in France. So they trade in France, but it doesn't look necessarily at where the revenue composition comes from. So that, and an example, I wanted to look at specifically is the biggest weighting in the French ETF. So Keith, could you bring up small financial statement from Louis Vuitton, and I'll use this as an example of the geographic weighting of the company and where they generate their business, and you'll see that this portion of is taken from the Louis Vuitton financial statements and their annual report, and it shows, you'll see in the green highlighted area there, that in fact France is only 8% of the revenue that they generate. So is this really, it could be argued that this isn't really exposure to the French economy at all, or the economics of France at all. So, but when you look at the indices, the index itself, the weighting in Louis Vuitton, it's 13% of the index. So you would expect that you're getting exposure to France through this ETF. You're really not. You're getting exposure to French companies that are domiciled there, but do business potentially globally. And in the example of Louis Vuitton, it's quite evident that their 13% weighting in the indice is not representative of the exposure that you get by owning that company to the economics of France. You're only getting 8% in that company.
Yeah, so Craig, I'll interrupt, and I'm looking at the chart right now, and we can see that Asia and the United States, between the two of them, are darn close to 60% of their net sales, I guess, delivery in that company alone, let alone other markets and Japan and whatnot. So
exactly,
yeah, case in point, it's very little.
That's right. So you can't argue with the technicals, of course, when we're looking for exposure to an indice, but when you're looking for the true indice, that's what you're getting the exposure to. You're getting it to the indice. But from the fundamental side, when you think you're getting exposure to a diversified portfolio and getting exposure to France, you're not necessarily getting to the economic realities of France, yet you're getting exposure to companies that are domiciled in France. So it's not quite necessarily as it might appear.
So is this similar across most of, for example, we're talking about the France ETF iShares, and would this be similar to most of the top companies in that ETF, that the amount of actual revenue they derive from France itself is going to be not it's not as great as one might expect by buying a French ETF? Is that, would that
yes, that's exactly it. That's okay. Exactly, and Louis Vuitton is the biggest. It's the biggest weighting in the indice, and it's so obviously it's the best example I found. But no, it is true of others, and it's also true of other indices. So it's when you're looking at if you're looking at a Japanese ETF, it's similar. Now, to varying degrees, but often I think European ETFs tend to have more of their more diversification as far as geographic revenue diversification than just then their exposure is more diversified across the world than maybe other such as China might be a better example, where there more of the weighting in those indices is driven from revenue that's generated in China. I think the weightings are greater there, but still you don't always get you don't get direct complete exposure to that geography. You are getting exposure to others, but the concentration is greater in China.
Right. So you're really just looking at what could be great companies in the that particular geographic region that's represented by the ETF may have fantastic companies that you do want to own and you want to access them through the ETF, but you're not necessarily buying something that's representative of the economy of that region. You're buying good
Yes.
companies in that region. So
Exactly. No, that's exactly, and that's what I wanted to. That's really the overall understanding I wanted to present and walk away with, was that it great companies. You're not denying that, but it's the makeup that you think you were getting diversification on a geographic basis, and it's not quite as it appears.
Excellent. Okay. And actually, I'll just bring up for the readers of the blog, I blogged a while back, not much back, probably 2-3 weeks ago, about different types of recession proof type companies. And one of my findings was that the very ultra upper end of discretionary purchases, because normally in a recession, you go through people buy less of the fun stuff and just concentrate on being able to feed their families. But at the upper end of the consumer, meaning the not just upper middle class, but the upper end, the people that buy Ferraris and Louis Vuitton type of products, they tend to keep buying. So they have these stocks like Louis Vuitton, for example, they're worldwide, and there's rich people all over the world, so they sell their handbags and expensive booze or whatever it was that they sell all over the world. So another interesting thing. So okay, so that's it. Really, I'm glad you started off like that, because we'll talk about other aspects of what you look at, but that is one of the things I know that you're looking at. So I wanted to ask you, and this is really I have a list of questions that you and I kind of discussed that we should maybe have you talk about, and they're in no particular order, but I mean, if I were to focus on one thing that you always talk about is a catalyst. So like when we talk about a stock that's going to break out, so technically I'm looking at something breaking out, or a market's going to break out, it's the most important thing is, just because it's breaking out, is there a catalyst to make that breakout real or continue? So can you just give us some update on what you mean by catalyst and what kind of things could be a catalyst?
Right. Good. Sure. A couple examples of things that would be catalysts come from the management side often, whether there's a management change that's coming, whether that's due to succession, or whether it's due to someone getting fired and not doing their job properly, and investors wanting someone else to be at the helm. That would be maybe a positive catalyst. On the other way, if lack of succession and then the forced retirement of somebody would be a negative catalyst. If a company is moving into another area, and that it was largely forecast, and largely they've been working towards purchasing another business to make it a subsidiary or something, and that would be a catalyst. Maybe on the positive side, if they conveyed the message properly that they were going to be doing that, then, and working towards it, then it could be set up as a positive. However, if they didn't telegraph it, and management didn't give clear guidance that they were looking at expanding their business, and all of a sudden went out and made this acquisition, it would be negative. So those are type of things that some of them you don't necessarily see coming, and that would be that you can't prepare them necessarily for those. But sometimes others that it's getting closer to the realization of that catalyst, and maybe you see it in the charts first. Maybe that there's an inkling of it there. But those are the type of catalysts that we would look for. And sometimes you can forecast them. Sometimes you can see them coming, and other times you can't.
Okay, so, and that probably ties into, this is a question I had. I mean, I work with you every day, but, sometimes I'm always scratching my head on how you're trying to estimate a company's possible or potential success. So sometimes I will come to you with a stock that's broken out. So again, I'm using breakouts because it's my favorite formation. Often I come to you with trending stocks, as you know, touching a trend line. But let's say a breakout. So it's been a bit of a head and shoulders or cup or whatever, and it's broken the neckline. So now I'm going to you and you're telling me if they've got a good business model and if there is a catalyst for that breakout to continue. But the next thing is the timing, because as a technical guy, I'm just saying, hey, it broke out. Yay. But you're usually then you're saying, well, there is a catalyst, but and you're trying to figure out, well, when that catalyst may trigger the stock to continue going higher or do go higher. So can you give me some insight on what might cause a longer term leg on that breakout, meaning a more meaningful move, or a lower, just small move?
Right. The larger move, it really comes from things that have changed. There's got to be a number of things. I wouldn't necessarily, it's not always one thing. I think that might be the biggest difference in whether it's a larger breakout. Is you need more than one catalyst. Maybe it's a culmination of a number of things coming together. I think largely, if a company is working through they've worked through a plan that is a reorganization, and they've had some they've had some success in that, and it's built up over time that investors are becoming really more comfortable with the probability of them having success at this new direction that they're taking, and they're getting more comfortable because there's been developments. There's been a new management team, some new senior managers come in. There's been some smaller, maybe tuck-in acquisitions that fit nicely with this new direction, and that type of buildup, the culmination of these things together could be seen as something that's responsible for a larger move. Maybe a smaller catalyst and a smaller breakout might be the result of changing their having a better earnings season, or having a better buying season. Maybe a good time here might be, or Keith, to bring in the chart that we talked about for Nutrien.
Okay.
And if you could bring that up, maybe I could illustrate one of these smaller moves that we might see soon as a result.
Yeah, because actually that chart will allow us to see some time ago when we originally bought the stock and the breakout, and then recent action when we sold it, and you can talk about your reasonings beyond the technical stuff that I was talking about, the reasonings fundamentally for liking the stock when it broke out, and not liking the stock when it broke down, and starting to maybe like it again now. So
right.
Give the reasonings.
So in the larger breakout, I think we would see it in 2021, right? That was the move that we had owned it. We had owned it into that purple line, but that was a bigger, right? That would be a bigger breakout. Is that not true?
Yeah, so we bought on the original kind of bottom formation, but there was that resistance at the purple line. So we were very cognizant of that. So we had stepped in pretty gingerly. But yes, once the big purple line, which is and you could see it did pause out there.
Right.
Once that was busted, we got very committed to the stock. I think we started off at 2% and moved our way up to 8 or something like that, right?
Right. So and at that point, okay, so that was we had more confidence in it there. Now I would move to 22, and this would be a smaller break. That move there was a break, and that was really saying that was the catalyst for that move was the unrest and the conflict in Ukraine and Russia. That's the timing on that, and we can see it didn't. It was pretty quick in when we look back. It broke it in early 22, and then by the middle of 22, it had stopped. Right. So, and then as we move to today, and that's what I think it's another one of these levels where there's a catalyst to go higher from this, maybe around here. The catalyst being that the inventories are so low, and that farmers really need in North America to replenish, and that replenishing, that buying will, I believe, solidify and give a firmer price and firmer volumes to Nutrien to be able to be more profitable going forward. And I think that potentially the new buying season, the new filling of inventory by farmers for the food for their crops will potentially be something that'll support the stock here and push it to move higher. That's from my fundamental belief that it's not a huge change in strategy, or it's not a new monster move higher or change in the company's direction, but it's something that is positive to give it maybe a move to the top of the range and that level. Does that make sense as far as how that the difference between a big multi-catalyst move to maybe a smaller more concentrated catalyst?
Yes. So this so just to kind of put it in a summary format, when we bought it, it was quite undervalued and we stepped in. So Craig noted that the kind of ballistic move out of that small cluster in early 22, then Ukraine and all that happened, and the stock went bananas. And we actually we had reached about an 8%. I think we were actually holding about a 6% portfolio position, but it turned into an 8 because the stock just outperformed so well during that period. And so we started legging out, just like we legged in on the way up. So we started legging out because between Craig's view on the catalysts and my view on the technicals, between the two of us, we were just saying, okay, we're going to leg out. So we sold some on the ballistic move, probably not very high, I can't remember, but it would have been around here, and another chunk there, and another chunk there. And when it broke down, by the way, we eliminated our entire position, but and so now we're looking again. Why? Because that old resistance point is going to become a new support point, and sure enough, it is. And this is what Craig, you were saying, is that there is a catalyst that could bring it back up to at least the old support level, which was here around maybe $100. Is there a catalyst to bring it back up here again? That's to be seen. But you're saying that, look, they've got to restock. They've held back. So you see how the two are moving together. Is that we saw a support level. And that doesn't mean anything unless there's a reason for it to bounce off of that. But Craig's got a reason. So
yeah,
hopefully
that great summary. Yeah, that's exactly.
Okay. So that's really, if everybody fell asleep at this point watching the video, you could almost do it, because that's most important things for you to discover through what our conversation is here. But I wanted to now just kind of go a little deeper down the rabbit hole, and maybe I'll start off because I've got 2 questions for you left, and I'll tell you them both up front, and you can ask answer them in either order you want, Craig. But one is like to describe the common perception, real or imagined, between value and growth investing, and where your ways of doing things fits into that. And maybe leading from that or into that are the type of metrics you use, because everybody that watches these videos or reads my blog know that, hey, Keith uses trend lines, he uses this, he uses that. They don't know what you do. So let's talk about your views on value versus growth, and also your views on, therefore, what tools you like to look at as the nitty-gritty stuff.
Right. I would say the nitty gritty is always, it's hard to, because I'll have to relate it a little bit to the technicals to say that, you know, a technical, looking at a company technical, you don't care if it's an auto producer or if they grow bananas. You don't, the technicals are the same. But from a fundamental side, if you're looking at a car company versus, you know, a food producer, it's quite different in the kind of metrics you want to look at, because certainly the car company is going to be more cyclical. There's just going to be there's more levers that can change the dynamic of that company in different times in the economy, different times in a business cycle. However, a food producer, you're looking for, it's a more consistent business. So you want to see more consistency, and you would understand that it should be more consistent because the levers are not the same. So you want to see, you know, and then at that time you could see you could, you know, look for a higher multiple. And a higher multiple on what? Well, a higher multiple on cash flow, a higher multiple on earnings. Both of them, you know, you're looking for, and you can expect to pay a higher multiple on something like that because there's greater consistency. But with a more cyclical company, you can't rely on that. Now, to go into the value and the growth, it's kind of, in my mind, it's similar. You're going to look at different metrics, and, you know, a value company or a value way of looking at things is where you've seen something that's more established. You can recognize that, okay, this company's been in business a while, or they've got so much capital intensity that, okay, if they go through, yes, the business cycle impacts them, you can recognize value and say they've done it before, and it's cheap now because they've gone through some hard times, but they get back to, we want to say they're going to get back to, you know, peak earnings, or they're going to get back to, you know, making money. Then you can buy that at a cheaper valuation and look for it to go back to, you know, a strong valuation. A growth company, you're really looking for something that hasn't reached maturity, has growth where it's greater than the average, it's greater than the economy, it's growing more than the economy, so it's certainly growing more than inflation, so that, you know, you're looking and trying to value on the cash flow and the earnings growth going forward. So in 5 years from now, it's going to be a company that is, you know, has a greater value because it's grown over the last 5 years at a certain rate. So, you know, discounted back to today, you're saying, okay, you know, I can invest in this company now with the expectation that it's going to grow in 5 years to this. Okay, great. It's going to grow, you know, 30% this year, 25% next year, 35% the year after, whatever that dynamic is, but it's growing at double digits. Well, compared to a value company that maybe is growing 2%, 3%, 2% again, like that is really where your difference is. Now, are you going to pay? You're going to pay a higher multiple for that growth in the expectation that you're going to get it. The risk, though, is that you've now paid for something that doesn't transpire. There's greater risk, I feel, in the growth. Because why? Because they haven't done it before, right? It's not only that you can value it on that, okay, they're going to deliver this. Well, they might not. The risk, I think the risk in a growth company is greater than the risk in a value company, because I feel value, they've done it before. They've been in business longer, or they've got a business that is less risky because you're expecting less growth from them. A growth company, by its nature, I believe, has more risk, but you're getting compensated more with the expectation that they're going to grow more.
Okay, so I'm actually going to add a comment and then a final question. And so these are on two different stocks. So brace yourself, Craig. Craig didn't even know I was going to ask these. So, I'm throwing these aren't curveballs, don't worry. So the comment, just based on what you just said, that one pays up for the prospects of growth with a growth company. Is that a good summary of what you were more or less saying? You pay up for
Yes.
that, but that potential, right?
Yeah.
So one could argue that people are paying up a pretty good premium, which may or may not be justified. We'll see in the future. And that's the risk you're talking about with these AI companies. I mean, there's great potential. There really is. But have we just paid a premium for those stocks that represents everything? And we don't know the answer to that, but that's the risk you were talking about, correct?
That's exactly it. And AI is a wonderful example of a growth mindset that you, as an investor, you have to have that growth mindset if you're investing in AI companies. The value just hasn't been proven yet. So we don't know. You can't. It would be hard. I believe it'd be very difficult to make an argument that these are value companies.
Yeah. So I thought it would be an okay example for you so here's so now I get to throw this at you. We talked about Nutrien a minute ago, and like, to me, there's an expression called GARP, right? Growth at fair price or whatever. So it's trying to combine the two. Would you say that Nutrien represents sort of, like, it sounds to me like you're saying, oh, they need to restock fertilizers and grow so there's a bit of growth potential from current levels, but it's also undervalued maybe, or how are you going to address that?
I would look at Nutrien more as a value, as a value enterprise. They've it's a business that has existed for a long time. It is established, and yes, they changed the mix. They changed the additives they add. They market it a little differently, but at the end of the day, it's food for food for crops, and that's at the end of the day, it can grow, but it's not going to grow at I don't think it's going to grow at a significant pace that you would refer to it as a growth company.
Yeah. So we're just trying to pick a spot where we feel that the price versus what the company can earn in the future, is maybe a little offside from what we might expect.
There's still potential there. There's still lots of potential, but you're not paying for it to grow 10% this year and then 20% next year and then 30% the year after. That's not the expectation. The expectation really is they're underpriced for what they can deliver and the potential they can deliver in a better than in an environment that they get back on track. And I think it's an established business that has just fallen offside, and it is underpriced. I believe at this point.
Okay, so, and I should, for disclosure purposes, we don't own Nutrien because, as I mentioned, we sold the last of it probably a couple of months ago. But we are, it's the 14th of June as we record this. We don't have a position, but you will probably be, you viewers will probably be seeing this video about a week after we recorded it, and we may have actually done a leg in. So that's, we're kind of recording this at a time when you're hearing us make the decision to probably buy, at least do one leg back into Nutrien, and we always work with legs. And if you take the technical analysis course I've done online, you'll learn all about legging in. So that's you're seeing it live in Technicolor as Craig and I make a potential decision. So Craig, I wanted to thank you for doing this, because it's something that I wanted to get people to hear your side of what we do together, and I think we covered it. So
Good, great. Thanks, Keith. We'll do it again.
Yeah, absolutely. We'll maybe and I'll encourage the viewers of the video, go to one of the blogs, because it's easier to comment. But if there's a topic that you would like Craig to cover, we could do a second interview, and if there's maybe a little bit deeper down the rabbit hole of fundamental analysis, because we wanted to do a high level view today. But if there's other stuff that you're interested in, and we could do a follow-up interview in a couple of months and answer some of the deeper issues that you might want to know about. So thanks again, Craig, and we'll
Thanks, Keith.
all right, thanks, Craig.